All right, all right, all right. We are live Monday night, 6 p.m. Pacific Standard Time. As always, tonight we have a special guest. You'll recognize Jimmy Hobson here, great mortgage broker who I have the pleasure of joining me tonight. We're going to do a market update. We're going to talk about the mortgage market, the real estate market, field any and all questions you guys have as always. So thanks for joining us. I guess before we get started, maybe we'll do an intro, Jimmy, let people know where you're at, who you are, what you do, and your favorite candy.
Nice. Jimmy, obviously I'm a mortgage broker based in the great state of Utah, just north of Salt Lake City. Been in the industry 5.5 years. Love it. Heavy presence in VA lending. Did about just under 100 VA loans last year. So I do obviously a ton of conventional too, and the other sorts, but that's really it. Husband, father of 4. Happy to be here. Reese's Peanut Butter Cups, best candy of all time.
Oh yeah, those Reese's Peanut Butter Cups are good. I like anything with peanut butter.
Yeah, exactly. That's why I'm 10 pounds overweight right there.
I was doing so good on my 2022, get lean resolution, and then last night I found some Butterfinger ice cream. Whoever put that in the freezer, shame on you.
You know what's funny is I love peanut butter, but I don't like Butterfingers. Never have.
So good, dude. So good.
Yeah.
So everyone's wondering what Butterfinger has to do with the real estate market. The real estate market is chunky. It is overweight. It's tough. It's hard.
It's hard to chew without milk.
I was trying to think of a good transition there. And that's what everybody wants to know. I think we can probably, give our 2 cents for what it's worth and try to help folks out with what to expect in 2022, what we're seeing. You and I both have dozens and dozens of pre-approved buyers of all shapes and sizes, first-time buyers, returning buyers, move-up buyers. What are you seeing, I guess, in Utah as far as the start of the year with home buyers?
It was weird. It's like the last week of December and then the first few days of January, I'm like, okay, we may get a little bit of a reprieve here. And then all of a sudden it just unleashed. Now we're back to 20 offers on every house. Any house that's under 400 grand is selling for 20, 30 grand over. It's just ridiculous. And I was telling you earlier when we were talking, I've got a couple of rentals in one part of a northern Utah town that if I literally sit on for 3 or 4 more months, I might have another 80 grand in equity.
Right.
It's just ridiculous on a 50-year-old house that's 2,000 square feet to gain 80 grand in 4 months.
Right. Yeah. And there's all these different things that cause folks to, get in a frenzy state. I think that frenzy was a word that was used early in 2021 when there was 25 offers on every house. And what I'm seeing in my area is anybody who follows mortgage knows. And if you don't, me and Jimmy here as mortgage professionals are here to tell you these last 6 days, Monday this week and all 5 days last week, there has been a steady move up in mortgage rates. I tend to look at it and not say the sky is falling, but as far as like mortgage rates and movement, it was a pretty sharp move for that short a period of time. And I honestly think that that's part of what's causing this frenzy is I've got buyers who are like, oh my gosh, like if it was 3.25 a week ago, and now I'm quoted with the same scenario, 3.5, like I don't want to wait a month and have it be 4.25. And so they're, looking at a market that has limited inventory, and probably settling for less than the ideal house. And they're, some of them at least are in kind of a frenzy state. I just called 2 or 3 listing agents today because I tell my clients, let me call the list side, help you get an offer accepted. And it felt eerily similar to 2021. And, thanks. Your guys' offer was great. It was well written. We got 3 higher offers that were cash. So we got a total of 12 or 15 offers, even those yours came in above ask and well written, short contingency periods, like the cash offers were even above yours. Like, holy moly, it feels competitive. And I think, if folks want, a housing market outlook, me and Jimmy, both for the sake of all the clients we work with, want it to be an easier year. a tamer year in regards to, home price appreciation, but I wouldn't hold my breath. And I wouldn't hold my breath for, a buyer who's like, you know what, I'm kind of on the fence. I qualify now. I may buy, but I'm just going to wait and see what happens. The wait and see what happens has not worked out well for people these last few years. Before we get too far into it and too many people on here firing questions at us, I want to make sure that I got some questions from some of the folks at U Mortgage. So I want to make sure we answer those. I'm just going to post these here in the comments. Let me see. And let me see if I should be able to pull this up on the screen. So check this out, Jimmy. This is a question. I'll let you go first.
Got it.
Is it wise to buy into the market with high prices and high interest rates?
Oh boy.
Where do we start?
I mean, so here's the reality is, depending on where you live in America, prices are never going down. I mean, we're in what some consider the strongest economy in America. There's a massive tech boom going on here because a lot of people are coming out of Silicon Valley from California. And so, sometimes I don't know if you really have a choice. Is it wise? 100% it's wise. Obviously, you get the tax write-off. The appreciation is massive. What people don't tell you is the very same size place that you rent is $500 more a month. So if you can buy a house, you certainly want to. Yes, high interest rates is kind of laughable. You and I were talking earlier. My first house was 8%. I remember my mom, who's been in real estate since the early 80s, said it was 16 to 18%. So, 3.25%, oh, crabby, whatever. It's like, I've never refinanced myself and I'm still higher than that. You know what I mean? So, is it wise? It depends on what you're trying to accomplish. If you're going away, if you're planning on moving out of state in a couple of years, maybe not. Right. And if that, and is it wise to strap yourself to 50% debt ratio? Probably not. But if you've got the means and the funds and you can buy a house that allows you to step up to a bigger, better house in the future, which is how all of our moms and dads did it. I certainly think it makes sense if you find the right place.
Yeah, I think the house that I grew up in, my parents bought in 1981, and I think they had a first and a second. I think the first was 12, which they were ecstatic about. It was so low, it was only 12, but the second was 18%, which, puts things into perspective. I did a fun little thing just out of, curiosity, being a numbers nerd. And I typed in like different home prices with a rate, and rates might not ever get to 12%. But think about like if you bought something that was 200,000 and you had a 12% interest rate attached to it, for that same payment, you could get something like 425,000 at 4%. I'm not even using today's rates. I'm using 4%.
That's crazy.
And so, that 8% works out to like 300,000, but it's just proof that like, you gotta think about it in context of total payment. At 400,000, 4% is 1909 in principal and interest. And then, it's over $2,000 if it's 200,000, if it's half of that amount, but it's at a 12% interest rate. So, I'm with you where like there's so much value in home ownership. In California, rental rates are going bonkers, right? And so if people tell me like, what about these high prices? Like, what's your alternative? If housing is expensive, and everything's inflated, right? The cheeseburgers are more expensive, the gas is more expensive, everything's more expensive. So housing, you've got two choices. You've got expensive rent or an expensive mortgage. You get to choose. One, you get debt pay down, you get appreciation, you get tax write-off. The other one, you get to help make your landlord rich. And, as a real estate investor, I don't want folks to continue to pay my mortgage, pay my debt down. I want them to eventually become homeowners, but
sure,
there's a lot of people that are going to stay in that. So let me pick another one of these questions real quick. Then we'll start to pick off some of these.
Well, I was going to say something too, is like, I think a lot of people are going to find, where our culture in America is not like other cultures in the world, eventually you may have 4 or 5 people on a mortgage. I know that's not uncommon in Southern California.
Oh, right. Yeah.
To be able to afford some of that stuff. So
yeah, and I mean, I think that there's a lot of people that do like, multi-generational type living and whatnot, where it's, maybe mom, dad, kids, grandma, grandpa, all in the same house, and everybody's kind of putting in on, like, you can do that in a big house and you can rent it and pay $2,700 a month, or you can buy it. And, the generations that hold on to that house are going to see all the benefits of the appreciation and the, debt pay down. Okay. We're going to take another question from you, Mortgage. And I think this is a good one. And this is a question I get a lot, right? Is what's the best advice you have for a first-time home buyer? I've got all kinds of good advice, and I'm sure you do too. I think if I was thinking of one piece of good advice, get yourself educated, right? Like, it seems like a big, scary thing, buying a piece of real estate that costs hundreds of thousands of dollars. I promise you that once you do it, you'll look back and say, oh, that wasn't too bad, especially if you're working with the right people. If somebody comes to Jimmy in his office, and I know, the folks in his office are all like-minded. They're trying to, make the home buying journey a smooth and easy one for folks. If you come to me in my office, brokers across the country, I know, do a great job of making it a smooth and easy process for the consumer. If you get yourself pre-approved and you've got all your ducks in a row, and you get, the person to present to you, here's what it's going to look like at 300 and 325,000. You put 5% down. Here's what your payment is. Here's what your total cash to close is. Here's what you should expect. Then you're empowered, thinking like, okay, I know exactly what I'm getting into, right? Go out there with a real estate agent. You find the house that matches the mortgage payment you're trying to land on, and you submit an offer. That, is easier said than done in some markets, but that's it. And, the place where first-time home buyers get lost, afraid, and scared and all that is when they don't know, right?
Yeah.
And they're out there just wandering aimlessly, working with somebody who may or may not be a professional. Get yourself into all kinds of trouble going out there and shopping for homes, getting emotional about homes without being pre-approved or without doing that stuff first. So,
I mean, that's the biggest thing. It's lack of education. They just don't know. They don't know what they don't know. They have no idea that they're going to need a home inspection and they're going to pay for an appraisal out of pocket and things like that. They just don't, they're not prepared for the financial cost of it. I made a post on social a week ago, and the biggest thing is, they need to have a better idea, for any buyers, frankly, but first-time buyers especially, about what it costs to maintain a house, what utilities cost, what it costs for the garbage man, what cable costs, things like that, and that's why, if they can find a professional, a mortgage broker like ourselves or the people we work with, that can kind of walk them through the process. I've owned a home for 20 years now. So I've seen all the ups and downs of a $118,000 house, my first one, to, the one I live in now that's 5 times that, and so on and so forth. I think the biggest thing is, like you said, education. And that's really what we're striving here, is to try to help people understand, what things look like, and that's the scary thing, because buying a house is, it's not necessarily scary if you have all the tools in the toolbox.
Yeah, for sure. I agree. All right. Everyone who joined tonight and logged in, I appreciate you. I want to say hello to Kevin Hawthorne here every week. Thanks for joining, Kevin. What happened here? Why don't that show up? Oh, there we go. Jermaine Battles, thanks for joining, man. Will the builder's preferred lender, in-house lender, match an outside lender's rate? I've got an answer for this one, because I honestly think that's the wrong question, at least where I'm at, and I won't speak for the whole country, but in California, the in-house lender who's getting the stuff spoon-fed to them has no real incentive for providing good service. And I've got people that have come to me and said, listen, I don't care what the cost is, like, do my loan. This person I've been working with who's an in-house lender is terrible. It takes them 2 days to respond, this, that, and the other. I think that the better way to approach it, and this is just me speaking personally, is you want an outside lender who you like and trust, who you know is going to deliver on service and a timely close, to match them. And I've made videos on this too, where I've flat out said, if I can't match the builder, I'll tell you so. And depending on the market cycle, there are going to be times when the builders are offering $7,500, $10,000 in credit to use their lender. Sometimes it's because they own that lender and they just want to keep it in house. There's all kinds of different things that go on.
Yeah.
But if I'm far enough off where I can't match it or beat it, I'll tell somebody so. And there's been a few cases where I've had to say that. There's been one where a buddy of mine was like, please, dude, like, I don't care if I pay $3,000 more. In that case, we ended up taking a higher rate, getting a credit, and I refinanced them out of that a few months later, but that's another story. But, I guess my point is, know that when you're working with a builder, you don't have to use their lender. So take whatever they're giving you and take a look at it and then compare it side by side with a mortgage broker who you like and trust. They do some weird stuff, dude. I had one recently, Jimmy, where they showed my client a loan estimate. I said, oh, no problem. I'm beating that by $3,500. We order fees from title, we disclose, and somehow there's a $5,000 marketing fee. And this was not anywhere on any paperwork, anything he'd ever seen. And the builder goes, oh yeah, if you use an outside lender, we charge a $5,000 marketing fee. How crazy is that? Like, it's not like, hey, we offer an incentive to use our people. It's we offer a disincentive if you try to use somebody else. So
yeah, I mean, I don't see much of that out here. Like, I'm looking to build a house, and one of the builders out here wants to give me $2,000 in sod, and they're going to charge me a bunch of fees. I'm like, doesn't make any sense. But yeah, but you're right. Traditionally, a lot of them actually have pretty good deals. You're just dealing with someone that doesn't really know what they're doing. They're being fed by the builder. So, again, it's all about comparing apples to, apples and seeing what comes out. 9 times out of 10, we're going to be able to do the same thing and make sure we get someone taken care of in a timely manner. So I see it a lot with VA, obviously. And, they offer these incentives, but none of these in-house builders know how to do a VA loan. Like literally I could go and teach them for 6 months. They probably still wouldn't know. So it's painful for me, when they offer all these massive incentives, and I tell the veteran, I was like, you got to take it. It's a good deal. Just let me walk you through, make sure you get it taken care of.
Right. So. Yeah. And that's the thing too, is when I've compared side by side, I'm like, hey, listen, you probably just take their deal and take that $7,500 credit. They won't give me, but they'll give you if you use their lender. Mm-hmm. Ask me questions as they come up, and no doubt it's like, he's saying this, it makes no sense. Can you clarify? And they need a professional, which most, you should have a professional on the real estate side and on the mortgage side when you're making the largest investment of your life. But yeah, that's the best advice there. Joey Garessi, I think that's how you pronounce it. Thanks for joining, brother. I appreciate you. When you say the Natties are on, I'm thinking you're in Washington. Is that the Nationals?
I think he's talking about drinking Natties. We'll see who's right.
I guess it's not even baseball season, right? What am I thinking?
No, yeah, I bet you I'm right.
Yeah. All right. Can you remind me how much you were required by Fannie and Freddie to put down on investment property? Is it 15% on one unit and then 25 on 2 to 4? Yeah, this has been coming up a lot. I get investors too that they're trying to put the minimum down, and you can put 15% down. And me and Jimmy work, with a bunch of wholesale brokers who allow you to do a 15% down single family residence. The pricing is nasty. And then when you do the 2 to 4 unit stuff, it's 25%. The only exception is if you're going to do an owner-occ, like an owner-occ duplex, you can do 20%, I believe. Right, Jimmy?
Yeah, I believe so. Yeah. Or you can go FHA. Jermaine's referring to the national championship, looking at this, his comment.
Oh, okay.
Yeah. FHA is a great option here. The problem is multi-unit are so expensive that very few 2 to 4 units pass self-sufficiency, where the other 3 units are basically at 75% of the rents of the other 3 units can cover the whole mortgage. That rarely, if ever, happens anymore.
Yeah. I did so many, because I work with a ton of investors, 3.5% down FHA 4-plex deals. And then like 2019, it started getting to the point where it's like, oh, this is getting tough on self-sufficiency. I remember like, get the cheapest insurance possible. We have to put a little bit more down. And for anybody who's watching, there's some video I did that's buried on my channel probably 3 or 4 years ago. But to simplify it, for FHA, you have to pass a self-sufficiency test where if you've got a a principal, interest, tax, and insurance payment of $3,000, 3 of those 4 units have to have rents. Is it 75% of their rents have to be 3,000?
I think so. Yeah, 75% of the rents have got to cover that 3,000.
Right. Yeah. So you'd have to have 4,000 in rents between those other 3 units, so that you do the 75% multiplier and get at least 3,000 in rents to offset that. And it's their self-sufficiency test. If you weren't able to pay, are these other 3 units going to be able to sustain themselves? And be self-sufficient. So yeah, that's really tough in California. People are looking at 3.5% down FHA and LA County or something.
We'll talk about it at a different time because we'll probably be back on. But this is one of the shining lights of VA lending is multi-unit. It's ridiculous because they'll just count straight 75%. You don't have to hit self-sufficiency. You can go 100% financing with full entitlement. It's amazing. I had a buddy of mine do a triplex. It was a duplex non-conforming triplex, and it hit the numbers, and they used the extra rents to offset the payment, and he's rocking and rolling. So
nice.
Now he's Airbnb to the 3 of them. So
sweet. You know what? I wish I had saved this question somewhere. I had a VA question on my live either last week or the week before. And I was like, hey, this is a good one. Make sure you tune in and ask Jimmy this. I don't know the VA guidelines well enough, but he was trying to tell me that he knew somebody that bought a 5 unit with VA. And I was like, I'm pretty sure it's 1 to 4, just like these other products.
I don't know. I've never seen one, but there is something in the guidelines about a 5 unit. Like it's almost like it's I don't know if you have to have a second veteran to do it. Something out there, but it does exist in the guides.
Okay. Yeah. It's one of those things where it's like such a unicorn. I'm like, they might even mention that, like if there's 2 veterans, I want to even say it was like 4 residential, 1 commercial. It was some weird...
I'm pretty sure. I think that's what I mean. I've never seen anything like it, but that's what I recall too. Is I think you're the 4-in-1. I think you're talking mixed use. To be honest with you.
Okay. No. All right. If somebody has that deal, bring it to Jimmy. He wants it. Sounds like too much work for me.
I don't know. There's probably someone better than me at that one. I can promise you. We'll take it to Sean Hammond, AFR. They'll do that deal.
Yep. Sean Hammond's got you covered, guys. Don't worry. All right. Nate and Jess want to know how long we have until those rates go up before we get squeezed. I guess my question is like, where's the squeeze, right? Like if rates go up to 4% by early April, what does that mean for you specifically? And I think this probably goes back to like the whole like advice for buyers, what to expect in 2022. If rates go to 4%, I think all the same advice I give applies. It's like there's no real timing the market, especially if it's an owner occupied deal. It's, do you have a stable job and income? Is your credit and your debt load in a comfortable place where you feel good? Do you qualify for a mortgage with a payment that's comfortable for you and your budget? And if so, home ownership's a go. Get out there and buy something, right? And like I could point to 1,000 different reasons why I believe in home ownership, right? Like the average net worth of somebody who's a homeowner versus a renter, like 45x, right? And it's sometimes by accident, right? Somebody who hasn't lived an extravagant life and just worked a stable job making $5,700 a month for 30 years. They didn't mean to, but over those 30 years, they paid this loan off, right? And they bought it for $250,000. It went up in value to $500,000, and now they owe $0. So they added $500,000 to their net worth. That person is probably not a bullish investor that's investing and seeing, $500,000 in net worth in any other parts of their life, except for in home ownership. Right. And so like, that's the kind of stuff where, I think rates are almost irrelevant because it's just a matter of like, are you personally in a position where, buying a home makes sense and you're able to?
Well, exactly. Like I talked about, 10 minutes ago or so, it's affordable and you're not overextending yourselves. Rates are irrelevant. Now, maybe to go a little deeper, and you probably did a video about this because you do a lot of videos, but the Fed's already tapped. They're going to raise rates twice this year. It's coming. So it's just a matter of how fast it comes. So if you're looking I mean, it behooves you to probably, I mean, if you're concerned about a quarter point, you probably ought to start looking now, because that's a stark reality very soon. So
yeah, I think I saw something, even was it today or was it the end of last week, where they were talking about maybe even 4 Fed rate hikes this year. So we'll see. We'll see if if they tick up the Fed funds rate to 1.5 or something, how that's going to affect 30-year interest rates. I think that the cat's out of the bag, and there was there was enough time where I'm like, if you like it, lock it. Rates are going up, and then these last 6 days is a little bit of I told you so, right? And I think people in general, they got to see it to believe it. And so if you want to believe it and you didn't believe it before you saw it, go to like Mortgage News Daily or one of these sites where you can look at interest rates and look at, August of 21 and today, or even look at 2 weeks ago and today. Rates have gone up. They're likely to continue to go up. It's not like a sales tactic where I want you to buy this week because rates are going up and you're never going to get a 3.375 ever again. But if you're in a position now where you qualify and it makes sense, don't wait. Times aren't getting any better. And back to like, hey, prices are high, interest rates are high. One, interest rates aren't high. You're just young and have never seen 8% if you ask the question. And prices are relative, right? Like Jimmy said, there's going to be some parts of the country where like maybe they level out over the next X number of years, but like there's a chance that you might never see the price you see today ever again. And that's something that like I still have to remind some folks that they'll watch enough, the sky is falling crash videos. Someone asked me today when it was going to crash by 60%.
Yeah, well, it's crazy. I mean, obviously we haven't seen a week like this last one in over a year, or maybe early COVID, right? But again, back to appreciation. So my house I live in now in 2019, I have appreciated 75% since August of 19.
What?
Yeah, I'll give you perspective. I paid $635. I put my house on the market today with the California buyer. I'm $1,050,000 to $1,1 million.
Wow! Holy crap!
But
Damn,
I can't
Californians.
Yeah, exactly. It's all you folks from California fleeing the West Coast. So
we saved. What's your state property tax?
It is super cheap, man. I mean, my taxes on that house are $4,800.
Wow.
Yeah, I mean, so our taxes are cheap. I mean, our state income tax is only 5%. So not that I want all your people to drive out of California and come here, but because our housing is super overpriced. But Boise's the same way as here.
Boise's
Idaho's
bonkers.
terrible. If you're going to go to Idaho, you got to go to like Idaho Falls or Twin Falls because you still get a little bit of a reprieve, but the market's just crazy. I mean, some areas in the Midwest, you're probably okay for now, but that's coming too. I mean, the market's just crazy wherever, and so again, back to their question that Nate and Jess have, I mean, it's just, they've got to figure out what's best for them. All we can do is give someone a guide and walk them down the path. And then they've got to make sure they're comfortable with it. I tell buyers all the time, it's like, look, I'm not ever going to spend your money. I'm just going to tell you what I see.
Right. Yeah. And that's the thing too, is like some of the advice I give about, hey, you're probably going to see higher prices and higher rates 6 months from now. People are like, well, I can't take your advice because, you got a vested interest in people buying homes and that's what you do for a living. That's how you make a living.
Sure.
I'm not living paycheck to paycheck. I'm just calling what I see. And you make the decision. It's your money. Anybody who's worked with us knows that like we're presenting all the facts and let people decide for their own, because ultimately it's your finances and your decision. But here's the captain. I'm a little bit behind on comments, but thanks for joining Casa and shouting us out. This is good times. I don't know about Jimmy, but I love this stuff, man. I could be on here for hours.
It's funny is it's the same thing. Like when I teach my CE class, I love it. I like, it's just, you get to help people see a different perspective and vision. And I'm an investor too. I mean, I own like 12 or 13 properties. So I can come at it from that side and see what the investor sees as well. That's why I think every real estate you can snatch up is worth it. If it's cash flowing $1 on an investment property, it's worth it.
Right. Yeah. I mean, that's the thing too. In California, it doesn't take a lot of real estate to be controlling and owning $4 or $5 million in real estate.
Yeah.
And you see a couple of years like we saw the last 2 years where home prices go up 30% in a 24-month span. You own $5 million in real estate. No, you don't have to be someone who has $5 million in your pocket, right? You probably leveraged it and financed a good portion of that, but that's $1.5 million in equity in 2-year period, right? And there's normal dudes like me and Jimmy that are doing it and own multiple rental properties. So yeah, I'm bullish on real estate too. Sometimes I'm like, I'm probably biased. You don't listen to me.
Yeah, well, yeah. I mean, we just closed on one last Friday, I think. So it's just if we can find the right deal, if it makes sense, we're going to buy it.
Sweet. All right. Nate and Jess started making YouTube videos again. Want to turn our primary into a rental and potentially buy. Also, we had a baby in October. Congrats on the baby. Lots going on. That's the best way to live life, is have all kinds of different things going on. A mortgage business, real estate rentals, 2 kids in basketball and coaching. And I like living fast. So I'm with you guys. Have all kinds of stuff going on. It makes life interesting. On this point of turning your primary into a rental, I think that's the best way to have your first rental.
Yep.
You buy a primary, you live in it, and you get good use out of it, and it serves its purpose for when you live in it. Then when you move out, you get to buy your new place with primary residence terms. You don't have to change the mortgage on your initial purchase. You just get to say, this is a rental now, and start renting it out. And I even counsel people who are, quote unquote, aspiring investors that, if you're young and you're buying a house, it's not the house you're going to live in forever. So buy a 2-bedroom, buy a 3-bedroom, buy less than what you need, knowing that 2, 3, 5 years from now, you move out and turn that thing into a rental. You might buy the first one with 5% down. You might get, the second one with 5 or 10% down. That way, everybody thinks that becoming a real estate investor requires hundreds of thousands of dollars. Yeah. And, when you're buying something as a primary, then turning it into a rental down the road, you're using primary terms, putting 3 and 5% down.
What I've seen lately, obviously I'll have people, they've got a great rate, so they'll pull a HELOC out, home equity line of credit, instead of, because if they refinance it and go buy another property, they got to refinance the investment, which doesn't make a lot of sense with the rates today, right? But they'll pull a HELOC out and pull 30, 40 grand out, and then they'll go buy another property as well, or go buy another primary, because the rents are so crazy that normally they can still cash flow even if they pull money out of the future investment property and buy something else. I've seen that a bunch lately, just because, people call me all the time, like, should I pull the money out of my house? I'm like, yes, but if you're intending to buy another house, you can't refinance the primary and 2 months later buy another primary. I guess you could, but they're going to ask you for 20 to 25% down if you pull that off.
And you know what I've actually seen, Jimmy? I have the same thing where it's like aspiring investors. They're trying to all different things. I've seen somebody do that where they refinance their primary. Yeah. Then they go and they try to buy a new primary, which for anybody listening, don't do that, right? Because, when you refinance your primary and say, hey, this is my primary, your intention is to live there for at least the next 12 months. So somebody did that. It was 45 days, 60 days later. They're in contract to buy the one forward. And they want it. The lender says, hey, listen, you just refinance this house. We'll do the purchase forward for you, but you're going to refinance this as an investment with us. And so while they're in escrow, they had to refinance their primary as an investment, which was what it was, right? Yeah. It was how they, should have structured it to begin with.
I had one, and what the lender did was, rather than do that, they basically wanted a good explanation as to why, and then they made them put 25% down.
Yep.
So it's basically an investment anyway. You know what I mean?
Right.
So.
All right. Caden Willard's here. What's up, Caden? Good to see you, brother. In case anybody was wondering about some of the magic behind the YouTube edits, that's my buddy Caden. He works magic. I can just record a video and upload it and mess up as many times as I want, and I don't have to look perfect, polished, and pretty. He does all that for me. So thanks, brother. Appreciate you, man. David Osborne, what's up, brother? Local dude, mortgage broker. Oh yeah, there we go. National championship, right? I thought it was. You thought it was Natty Ice, and I thought it was a baseball team. So we're too focused on mortgage right now. We don't know what's going on. Basilio, buenas noches. ¿Cómo estás, señor? Tamara's, she had to run. She'll catch the replay. Yeah, that's the beauty about these things. They'll live forever. If anybody wants to come back on and catch the info later, they definitely can. This is always fun, man. People are always asking me questions like this, where it's like, give me a rate quote. There's always missing pieces here, but I'll do my best to give you a rough idea. What you can do, Jermaine, is I think there's on Mortgage News Daily, if you scroll down, they've got today's mortgage rates on the right. I'm going to do both. I'm going to do it both ways. I'm going to do this, and there's like a, what do they call this? Like a rate survey. And then I'm going to actually price it, show you that a mortgage broker is a little bit cheaper and better service and all that stuff, right?
Definitely better service.
I haven't priced a loan in a couple of days. I've been busy talking to people, letting my awesome staff do all the pricing. So maybe this will be a wake up call for me. I'll be like, holy moly, 95826.
You're gonna cry.
I had somebody on my team be like, oh my gosh, this is a crazy rate. And then I'm like, oh, it can't be that high. And then I was like, is that a primary investment? It's like investment property. I'm like, of course it's friggin' 4.25, bro. It's an investment property. Oh my gosh. Am I crying? Holy shit, Jimmy, you weren't lying. Okay. So, this is what I'm going to do. Where do we go?
So Will just respond real quick. Sorry to cut you off. He said, even if you put 20% down, is it better to put down the minimum, use the extra money to make improvements? So, and back to Jermaine's question. So with mortgage brokers, especially with one of our big investors, mortgage insurance is so cheap with great credit. I talk people out of 20% down all the time. Because, I mean, you could probably put 10% down on a $500,000 house and have $40 a month in mortgage insurance. To me, $40 a month instead of 50 grand extra down. I mean, you put a pencil to that. What can you do with that money? So,
right.
Well, I'll let you quote the rates, but that's some great questions.
Yeah, no, for sure. And I'm a big advocate for capital, right? Like putting a bunch of today's dollars into something and letting it stay put, especially when you can borrow at 3.5%. You're a lot better off. I mean, last house I bought, I put 5% down and I could have put more. Here's what I'm going to show. I'm not going to show. Where's this? Okay. So this might be hard to see for folks, but just to get a general idea, like you can go to Mortgage News Daily and then you scroll down on the right and there's this 30-year fixed rate and you can just click on today's mortgage rates and it's going to show you like 30-year, 15-year. These are way off on FHA. I think that one's probably high too, but this is like a survey, right? So this is surveying like all kinds of different lenders. It tells you like the rate trends. You could look at, over the years, how rates have trended. I think there used to be some spot where you could look at like the rate and the cost for that rate. Because where you want to be careful.
It says 0.4 points. If you can see.
Okay. So 0.4 points for that 3.64. I priced 20% down. And granted, it's going to depend on your loan amount. If you're Amir Bally and you're in Michigan, your average loan amount's $72. Sorry, Amir, I just can't help myself. But a broker is going to be slightly less. If you were paying 0.4 points with a broker, you'd be at like 3.5%. So, we're going to be an eighth better than this, but this gives you a rough idea. I think even there's something on CFPB's website where it says you can type in your state, California, you can type in 20% down, you can type in your 760 credit score, and it'll show you most people are locking at 3.625. Some are locking at 3.5. Some are locking at 3.75. And it gives you kind of a general idea, best thing to do is just call a local mortgage broker. They'll be able to help you out and shop different lenders for your best rate. Amir has just got all these comments in here. He wants us to notice them. So shout out to Amir Bally. If you're doing anything in Michigan, this is the guy you want to talk to. He's the absolute greatest of all time in Michigan. Does a lot of loans there, has a great team. So thank you, Amir, for all. He's our biggest fan. So we're your fan too, brother. Doing good stuff in Michigan. I'm sorry for teasing you about the loan amounts. Maybe one day California is going to slide off into the ocean. I'll have to do loans in another state that has smaller loan amounts too, and then it'll all.
Yeah.
All right. What else we got here? You answered Will's question, right? Like,
yeah,
it's
kind of a two birds with one stone. I mean, back to his question again is, 100%. I think you should put less down if your credit's good, especially, and use the money to make the house the way you want it. There's no reason. I mean, if the last year and a half hasn't, 2 years now, holy crap, of COVID and COVID related crap, if it hasn't taught us anything, is liquidity is more important than equity. You need money in the bank. You never know what's coming. Right. And so, if your credit's really good, like I said, we'd have to run a scenario and a broker can do this, but mortgage insurance, with some of the big wholesale lenders is so cheap for the money, relatively speaking, what else you can get out there that, the old days, everyone's so afraid of it, the mortgage insurance boogeyman. And I'm sure you've done videos about mortgage insurance and the pros and cons, right? But if your credit's 750 to 800, it's not going to be much. So if you can save your money and spend it better places, put a garage on or fix your house up to your kitchen, make the house more livable, for you guys, well, that's what I would do. Personally.
Yeah, no, for sure. I mean, I recommend that. And then, on top of you could invest it and get a better return. You could put it in your house and that's great. Or like a lot of people do. And I know personally, like when we were looking at it in 2017, the last house I bought, my wife feels really good when there's money in the bank. And so, somebody comes to me and they say, I'm buying a house for $500,000. I've got $122,000 in the bank or $114,000 in the bank. Let's not use every single dime you have, get into a home. One, there's going to be things you want to do. And there's going to be costs associated with owning that home. Even if it doesn't need new things or repair, you're going to want new couches. You're going to want a new fridge. And so, that's part of that whole educate yourself up front. Look at it and say, oh, I didn't realize I put 10% down. I'll still have $62,000 in the bank and my mortgage payment is comfortable. My mortgage insurance is only $72 a month, even though I'm buying, for $500,000 with 10% down. So, I think at the very least, look at the options. Don't just assume you need 20% down. Don't assume that that's what you're shooting for. It'd be a really interesting thing to look at, Jimmy. Somebody who in 2019 was like, you know what? I've got 12%. I'm going to save until I've got 20%. I don't want to buy right just yet. Right. And now imagine they were going to buy your house for 600. Now it cost over $1 million. Right. How'd that work out for you? Cause you were trying to save, you only had 75,000. You had enough for 10% down, but you were trying to get to 20. Now you've saved that extra 70, but surprise, surprise, the house cost $1 million now. So that's where, I tend to disagree with Dave Ramsey and some of the folks who are you've got to put X% down.
Yeah, but that's why I work with the professional. I mean, obviously when they talk to you or your team and vice versa, they talk to me and my team and Kyle, is we run through the scenarios, let me show you this. I mean, and if they come back to 20%, I'm I always say, look, I'm not spending your money, but let me give you some options. So you realize the cost benefit, someone wanted to buy, pay down a rate the other day. And I'm well, it's going to take you 88 months to make up how much you're paying to buy that rate down. Now, if that makes sense, you can be there forever, do it. But if it doesn't, then don't do it. The average person refinances every 3 to 5 years. Now, if rates continue up for the next 5 years, you're way ahead to buy it down. But if they don't, personally, I would never buy it down. But one thing that's coming too that people don't realize is we're going to see a lot more ARMs, not the bad ARMs, not the option ARMs and the weirdo loans, but, legitimate ARMs where, you can lock a rate in for 5, 7, or 10 years, which which is amazing because you're probably not going to live in the house longer than that anyway. That's a no-brainer if it makes sense.
Right. Yeah. I mean, that's the thing too, is, some of these things change over time. And that's why there's a lot of value in getting up-to-date advice from a mortgage professional. Lenders, rate sheets literally change every single day. And it might be where 6 months ago, 9 months ago, a year and a half ago, you could buy down a quarter for less than a point. Yeah. Now I look at some rate sheets and I'm like, gosh, it costs you almost a point to go down an eighth. Yeah, would never do that, right? Like you go down an eighth, and I'm looking at a rate sheet right now on just a random scenario, and you're going to save $21 a month. I would never tell somebody to go out and spend a couple $1,000s to save $21 a month, because I'm a math guy and I could do quick math and say 100 months, very unlikely, like Jimmy said, that you're in the house for 8+ years.
Yeah.
And this is just the mortgage, right? You might still be in the house, but you might have refinanced twice in that 8-year period. So I think this is a conversation, to this question about, is buying points beneficial, where, it's specific to the person, but the questions that I ask somebody who's thinking about that: how long do you plan on living here? How certain are you that you're going to be in this mortgage for 3+ years? If it's more than like a 3-year break even, I'm not recommending it. It's only in the cases where somebody's like, I'm a fixed income. I got to buy it to this. I know I'm going to live here until they take me out feet first. And so in those cases, maybe we spend the money up front, but you got to also take into consideration, you're spending today's dollars to save money on future mortgage payments. And if, today is any indication of the future, where we've got 6.8% inflation, tomorrow's dollars are worth less than today's dollars. So you're going to save $21 on your mortgage payment 3.5 years from now, when $21 is a tank of gas and a gallon of milk. All right. This is especially for you because it's a VA question, Jimmy.
Okay.
When you buy multiple VA properties, how does the entitlement work? I get this question quite a bit too.
So assuming this assumes you're keeping a property. So let's say I own a property and I spent $300,000 on it, right? So simple math of the VA, 1/4 of that is tied up in entitlement of $75,000. Okay. So currently, when you have a VA property and you don't plan on dispose of it, then you are beholden to the conforming limit when it comes to buying additional properties. So, I'll do some quick math. So conforming limit now is what, 647.2. You divide that same number by 4, which is 161.8. So if you have, what do we say, $75,000 tied up in the other entitlement, if you minus 75,000 off that, you have 86.8 times 4. That means you could buy an additional 347.2. So basically 647.2 total. Now with the VA, any dollar above that, you pay 25 cents on the dollar. So if you wanted to buy a $447,000 house, for example, you put $25,000 down, but you can still finance the rest of it. So that's how it works. I've actually had veterans with 3 and 4 properties. If they bought their first house in a super inexpensive area, maybe Oklahoma, for example, or, backwoods Texas, Wichita, Kansas, something like that, and then they move somewhere like California, Edwards Air Force Base, or maybe here to Hill, they keep moving stuff around, but that's how you can move entitlement around. A lot of people will actually refinance their very first VA loan to a conventional loan so they can free all their entitlement up again. Now you can only do that one time with the VA. It's called a one-time restoration, and then they want you to dispose of the property. But the real secret to VA is if husband and wife are active duty together or have been in together, that's the magic, because they both have full entitlement. So they both can be on the same loan, but you can only use one of them's entitlement. So, so that's where, there's a lot of tricks of the trade. There's actually groups out there that teach veterans how to do that fraudulently as well, unfortunately, on Facebook. But, those are great questions, and you need to find a VA specialist. I'm going to give a shout out to my guys. If you're not a member of Vetted VA on Facebook, you should be, because you can get answered any VA lending question there is without any solicitation. So, go there and see my folks and let them help guide you down the path.
Right. Yeah. That's the thing too, is with any type of specialty loans, there's folks that are that are, very knowledgeable in that area. I mean, we write a lot of VA loans, and I know that when I get in the room with guys like Jimmy, he runs circles around me with the in-depth knowledge of VA stuff, and just being, somebody who does 100 VA loans a year. A lot of stuff because you've seen a lot of stuff, right?
Yeah,
besides, the knowledge of the VA, the vetted VA group, and all the collective knowledge you get there. You've seen enough and helped enough veterans to know that, oh yeah, in this scenario, this is how we do it, and help people do it the right way. This is a really interesting question. If I'm reading it right, you're trying to sell your house to yourself.
I love this. It's brilliant.
Sell my primary residence to your LLC.
So here's how you do this. I think if you live there, what I think you do is you refinance it into an LLC, not sell it. I think you refinance it on a non-conforming loan. If maybe like a DSCR or something similar, to do the LLC with the intention of moving out. And then, but there's a lot of a lot of accounting questions here.
Right. Yeah. I mean, I defer to a CPA because, I know the basics of the $250,000 exemption for selling your primary residence. But yeah, you're trying to, I think you're going to run into issues. I think is my first thought on something like this, where, if you're the sole owner of the LLC, you're essentially trying to sell it to yourself. I don't think it's going to work, but run it.
Yeah, no, go ahead. I mean, that's why I don't think they're looking to pull the 250 out. They're just trying to avoid capital gains. So that's why I think you refinance it instead.
Oh, I see what you're saying. Yeah, refinance
unless there's a bunch of equity. It's hard to say, but yeah, CPA on this one.
Okay.
Yeah.
Yeah, I mean, that's a beautiful thing too. But, for anybody who doesn't know, the beauty of refinancing and owning real estate is when you pull money out of a property, you don't get reassessed on property taxes. You don't pay taxes on the money you pull out. You literally get to pull out and recycle capital. And so anybody who's owned real estate for any length of time knows that, like, a decade goes by, you've got $2 million in equity. You pull 500,000 out. You go out and reinvest that elsewhere. You're not paying taxes. You're not getting reassessed on property taxes. Like, that is just, capital that you get to pull out and recycle. Right. That, you didn't do much to create that capital besides hold real estate and own real estate.
I think one way I think you could do this, if you got a spouse, then you could probably, there's ways to game the system. But now that you're live on video, Jason, you may not be able to.
Yeah. We just what do they say? Like, the IRS just joined the chat. The IRS just joined the chat. All right. Yeah. Thinking of doing a HELOC on my primary in Alameda County. That's near me. Hello. What parameters should I look for while comparing different lenders' products? On the HELOCs, my biggest concern for people, because we don't do the home equity lines of credit, I refer those to, usually small banks or credit unions can get you pretty good terms on those. A lot of them are variable. Few banks have fixed term type home equity lines of credit, but I think that's what you want to look for. Most all of them come with very little cost. They'll do like some automated valuation where you don't need an appraisal. And I've seen a lot of banks offering these with literally no cost at all. And so weigh it side by side with a cash out refinance. If you've got excellent terms on your first and you're not even considering cash out refinance, then so be it, right? But I know some people that have 3.75 on their first. You can look at doing a cash out refinance, probably being at or below that same rate, and being able to pull out the equity for whatever the plans are for that. The scariest part for me on the home equity line is, as the Fed starts ticking up the Fed funds rate, which they've said they will, you might start at a 4.5, but then it goes 4.75 to 5%. They tick it up another 0.5%, goes to 5%. And, before you know it, if you've pulled out 200,000 and that thing goes up to 7%, it's not going to look as pretty.
I agree. I mean, I think there's all kinds of alternatives out there. Depends on how much you're trying to pull. If you're looking at 10 or 15 or 20 grand, it maybe makes sense. Maybe it doesn't. There's actually some online lenders that will do personal lines of credit without tying it to the house too. And that might be a better solution. Depends on what you need. There's money for everything in the world if you look hard enough for it.
Right. Yeah. Alameda County, it's probably a $2 million property. And so you got plenty of equity and plenty of options. Oh, there's my buddy Sam Hoffer. What's up, Sam? Thanks for joining us. Appreciate you, brother. Sam and Corey, also amazing marketing folks. Let's see. Jeanette asked a question. I'm curious, Jimmy, what's your go-to for the consumer, just to kind of get a rough idea of what their home value is?
Boy, I use the system in EWM.
Yeah,
House Canary. It seems to be far more accurate than anything else I have, so I use that. Nothing else really works that well. So yeah, was it House Canary or whatever it's called?
Yeah, I think it's House Canary. And so yeah, Jeanette, like Redfin and Zillow are going to be accurate sometimes, give you a good ballpark. I personally like Redfin more than I like Zillow. I just think some of their data and some of the stuff is cleaner and nicer looking. But like Jimmy said, we've got access as brokers to some really cool stuff. If somebody reached out to me in California and said, hey, like, can you shoot me over like the House Canary report on my property? It'll show you like the trends, the market rents, what your home's valued at, what stuff has sold around you. Like, that's a cool report where, I'd love to save that as a PDF and send it off to somebody. So if you're in California, shoot me a message. If you're outside of California, then I might not be able to House Canary because I'd be referring you to another partner at U Mortgage, but Matt@mtmg.com. I know sometimes I get flooded there, so it might be 24 hours before I get back to you, but we can look you up. I mean, Redfin's gonna give you a rough idea, and really, if you're looking at doing a cash out refinance, or you're doing any sort of mortgage transaction, the professional you're working with is going to do their best to try to give you a good rough estimate up front, right? Because you're going to call and say, hey, I think my house is worth $800,000. I want to do a cash out to this number. And we're always going to look and say, well, conservatively, it should be worth at least this. Let's show you some scenarios at this number. Oh, Jeanette says she's in Northern California. All right. Send me a message, Jeanette. I'll be able to give you something. Well, we'll see what our value is on my system at my favorite wholesale lender versus the online stuff. All right. Will wants to know what questions you asked during a pre-approval in an attempt to pre-underwrite. For example, asking if a borrower has solar.
Don't see that much here. We don't get a lot of solar here, so that's not really a question we normally ask here. So really ours is just standard stuff, job time, job history, income. Are you a veteran? That's, those are the big questions I ask. Obviously solar is a lot more pertinent in your neck of the woods.
Right. Yeah. And that, probably where you won't see solar questions in other states, it's going to want to know if there's liens on title. Mm-hmm. And, I'll speak for myself on my own team. A lot of this stuff is, an online application, uploading docs to that online application. Every borrower is going to be different. And so there's going to be the standard questions. And then based on what information we get, there might be follow-up. If you're self-employed, we might ask for, the profit and loss. If, there's a debt on your credit report, once we run credit that we're uncertain about, then, there's follow-up questions with that. But, the questions are kind of built into the application. You're filling out application with your job history, your housing history. We're pulling credit and figuring out credit history. And then with all that stuff, we're collecting the documents that support all that. And, the follow-up questions are going to be based on what information we see in the application.
A lot of it real quick. I mean, the other thing I ask is, when I've talked to people before they fill the app, is are they W-2 or are they self-employed? Because if they're self-employed, I need to know how long they've been in business, because we may be able to stop it right there. You know what I mean? If they're a year in business, it's unlikely they're going to qualify, and unless they've got, unless they're going to go non-conforming, put 30% down, so just little quirky things like that people don't realize. We're going to start talking more about self-employment, just because that's a burgeoning thing, all the
Right. Yeah.
YouTubers out there.
A lot of folks are self-employed, and then,
Yep.
we're seeing a lot of people that are coming out of COVID and they've had, cut hours or time off work. And yeah, my 2020 is kind of funky. And so, yeah, we're living in a new world. I'm interested to see in the future what lenders do to kind of make adjustments for workers that aren't all W-2 anymore. There's more entrepreneurs, there's more self-employed, there's more gig type jobs being created every day. And I think it was the guy who runs Finance of America. What's that guy's name? Smart friggin' dude.
Bill Dallas.
Yeah. He did a really cool article just talking about the makeup of today's worker is a lot different than it was 5 years ago, 10 years ago, and how are mortgage guidelines in the future going to change to better suit today's worker. I thought it was really cool, like kind of a something to think about, right? It's not going to happen overnight. Fannie and Freddie aren't, necessarily going to write new guidelines in Q1 of 2022, but who knows, 2025, we might see some change. All right. Jason Garcia wants to ask about any specific downsides of the following leverage strategy. Take out a HELOC on my primary, use HELOC to buy an investment property, cash, take out another HELOC, use second HELOC to pay off first mortgage. Result: 2 properties, 2 HELOCs, 0 mortgages. Interest only on the HELOCs, and they rent out both properties, make cash flow, right? It's either late or I'm tired or
I don't know how he's pulling it off. That's a much longer conversation.
Yeah. I think, Jason, where you're going to run into trouble is you're taking out a second HELOC on the first property to pay off the first mortgage, or you're trying to take it out the HELOC on the investment property. If it's HELOC on the investment property, those are few and far between where you can actually find that. I think another thing you'll probably run into is, like, you're talking about buying something cash. With what you can get from a HELOC, you're going to have a ton of equity. Like if you've got $1 million home where you owe 200,000, that's one thing, right? Take out a 300,000 HELOC, buy a 500,000, buy an investment property cash, and then try to do a HELOC on that one for 200 and pay off your first property. But where most people sit equity wise, where they're at 60%, 70% loan to value, I don't think this works. Even in my scenario right now, where you're like pulling 300,000 off of a house that's worth $1 million with 800,000 equity, you still probably can barely do a HELOC for 200 on the purchase to do that. So now you got us all tangled, bro. I think you done put me and Jimmy to sleep. I don't want to keep you too long, Jimmy. I know you promised an hour, and I, truth be told, got to get the heck home to my family. But I appreciate you coming on, man. And we'll definitely do this again. We'll maybe make it a quarterly deal where we get on here and talk shop and field questions from the wonderful folks
I love
online.
it. Yeah, I love. Yeah. I mean, helping people, and obviously we learn stuff. There's stuff that I learn every time I talk to someone that does this job, just like you. So.
Right. Yeah, for sure. I know. I learned a little bit about VA tonight. I gotta stay in close proximity to you so I can continue to button up some of my VA knowledge, because you're a wealth of knowledge. For sure, we'll do a future one where it's going to be VA focused and all things VA, and get some of that vetted VA knowledge out of you.
Yeah, we'll get Sean on with us too. That'll be helpful. So.
Okay, cool. Yeah, we'll do all that, man. Have a great night, brother. Thanks for joining, dude.
All right. See you guys.
All right, good, man.